Okay. Okay, so I would say this slide is maybe the most important slide or it summarizes the main topic in this chapter, which is how to deal with bad debt. Okay, how to deal with receivables that are not going to be collectible. Okay, so we'll talk about the different tree, like how this tree branches off, but I would pay special attention to this. Okay, so um, when receivables go bad, what do we do about that? Um, well, there needs to be a couple of things. For one, the account receivable asset needs to go down. And remember, you initially recorded some sales revenue, right? You had accounts receivable, sales revenue. So if you can't collect your accounts receivable, we agree that this has to kind of go away. But we also have to do something about this part of it because our income statement is also affected by this account receivable being uncollectible. So we have to fix the balance sheet and we have to fix the income statement, both. Okay, because uh, when we can't collect, it's affected the original transaction affected both of those financial statements. So now we have to do something to correct both of them, not just one of them. We can't just reduce accounts receivable. We also have to figure out a way to fix the profitability of our business because we kind of overstated revenue if we weren't able to collect this account receivable. So uh, the way we're going to do it is not actually reduce revenue. We're going to take an expense. Okay. So the expense is going to be fixed, or sorry, the income statement is going to be fixed by taking an expense to offset that sales revenue. And we're also going to do something with the account receivable. Okay. So there's two methods. Uh, the first one, the simpler one, is the direct write-off method. Basically, what you're going to do is you're gonna just assume you're gonna collect all your receivables until there's some obvious thing that happens where it's uncollectible. Okay, so that customer says, "Hey, I'm not gonna pay you, whatever." There's a definitive moment where you're like, "I can't collect that receivable." At that time, you're gonna then write off that account receivable. Okay, you're gonna, as the name implies, directly write it off. Okay, so you're gonna record the bad debt expense after you realize that the receivable is uncollectible. So while this is simple, it violates the matching principle. Why is this? Why is this method not in line with the matching principle? Does anyone have any idea? So the problem with this direct write-off method is that when we actually realize that the receivable is uncollectible, it's going to definitely be in a different period, or I mean, it's most likely going to be in a different accounting period than when we recorded the revenue. Okay, so we're going to have a mismatch between the bad debt expense and the revenue that was recorded. Okay, so though this is simpler because we don't have to do any estimating, we just wait until we actually have a receivable that's uncollectible and then deal with it. It's gonna not be in line with this matching principle. We're gonna have the risk of having overstated our profitability in a previous period. Maybe we generated a bunch of sales by just extending credit to customers who are like not trustworthy. Okay, so in that period, our revenue would have been really high, but then only later in a future period, we would realize that all those customers are not going to pay us. Okay, and we would have to take a big expense in that later different accounting period. Okay, so we want to avoid doing that. Okay, but for small businesses, in certain contexts, maybe the direct write-off method it's just simpler. Okay, we don't have to do any estimating. That's really the big advantage of it. Okay, so now the allowance method, which is kind of the method as that we need to do, like we need to implement for GAAP. We're gonna basically do an adjusting entry at the end of our period, and we're gonna estimate how much of our accounts receivable we're not gonna collect. Okay, and it's not gonna be accurate because it's an estimate. We're gonna be using assumptions. We can't predict the future exactly, but we're gonna make an educated guess. as to how much of our account receivable is going to not be collectible and take the expense in the same period. Okay, so this does adhere to the matching principle, but it's just less accurate because we, again, don't know exactly how much of that account receivable at the end of the year we're not going to be able to collect in the upcoming year. Okay, we're going to have to estimate that. Okay, so how do we estimate that? Now we have these three different methods to do it. Okay, so these three methods is how we're gonna figure out. Let's say we had, whatever accounts receivable at the end of the year was $500, or 500,000, I guess. How much of this should we assume is uncollectible, right? What is the proper what is a reasonable way to estimate how much we're not going to collect? So there's, again, these methods: the percentage of sales method, the percentage of receivables, and the aging of receivables. And you can kind of, it could be argued that these are in increasing levels of sophistication. This percentage of sales method is, as we're going to see, I think the least sophisticated. Percentage of receivables is a little more reasonable. And then aging of receivables is a much more granular way of doing it. But they're all, again, getting to this uh, idea of how much bad debt expense should we take as an adjusting entry. They're all allowance method, because the allowance method is basically having to take an adjusting entry in the first place. But how much bad debt expense should we take? That's going to be determined by which of these three methods we use.